Hi guys and welcome back to Yashi. Today with the Federal Reserve update. Today the Federal Reserve released a statement about the economy, what they think about doing in the future and where we come from. They all started with the current situation, what they want to reach, what their main focuses are, inflation across multiple sectors. They also start separating inflation, which is interesting to see, and then end up saying what they think they will do in the future, what the possible outcomes could be. Let's get started. So, how are we standing today? The reality is, inflation is high. It's affecting especially the lower income families. And without the price stability, we cannot ensure that we have a strong US economy, especially when it comes to labor, to affording stuff. And that's why we need to reach a 2%, let's say, inflation. That's how they start out. They then start talking about data. Inflation, PCE, not the general inflation report, the PCE, the purchasing, personal consumption expenditures, has been at 6% in October. So a little down compared to what we saw in the past, but still higher than the 2% target. Core inflation, which is what the Fed wants to look at more, which includes everything except for food and prices, as food and prices cannot be controlled directly through policies and the economy in general. It's more of an international thing, is on the other hand at 5%. Better, but still too high. Pretty much where it stood last December when policy tightening was in the early stages. Over 2022, core inflation rose a few tenths above 5% and fell a few tenths below, but mainly moved sideways. So when will inflation come down? He then proceeds, and this is the chairman, Mr. Powell, then proceeds by saying that they could look at forecasts given by the private sectors, but if we look at the historical forecasts in the private sector in the past year, everybody was expecting inflation to go down, and they were all wrong. Inflation pretty much stubbornly moved sideways in the past year. The truth is that inflation right now and inflation where it could be in the future is still very uncertain. And for this reason, instead of talking about inflation in general, they now start talking about the macroeconomic factors and where they need to be for them to then expect inflation to come down. We start first of all with the interest rates that the Federal Reserve can affect. They still need to figure out what is enough for them to reach the 2% inflation point. Right now, we are at 3.75%. They've been doing a really good job at increasing interest rates a lot without destroying completely the market, in my opinion. But also, according to them, they've been doing a lot of effort to get to that level. But they also believe we need to go at a higher level to fight inflation, especially after the September meeting where they thought that they were getting closer to that level. In order to slow down growth and aggregate demand. Their objective here now is to slow down demand for things, because by slowing down demand, they allow supply to catch up and then create a good equilibrium in terms of lowering the prices or at least stabilizing the prices. Restoring that balance is likely to require a sustained period of below trend growth. Again, they're not talking about a crisis here, they're talking about below trend growth. Why is that? I don't know. The fact is we saw two quarters, first quarter and second quarter of 2022 being negative, but Q3 was moderate growth. Q4 is expected to be moderate growth. So maybe it's going to end up in a positive year with below trend growth. This is probably what he's talking about. Last year, the ongoing reopening boosted GDP to 5.7%, so it was a very good year. This year, as I just said, we expect to have a more moderate growth, but still a positive growth. Despite a tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it is useful to break core inflation into three components. And this is very good. I think this is the first time it actually happened. He's breaking down inflation in core goods inflation, housing services, and inflation in core services other than housing. And this is a good graph we can have that I can show in a second here, where you see the different lines and what they represent. Goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. So not everything is moving down, some things are still moving up, probably because of an issue with demand and supply. I've been talking about real estate a lot in the past couple of months, and there is a supply issue even if demand is going down. Early in the pandemic, goods prices began raising rapidly as abnormally strong demand was met by pandemic hampered supply. It suggests that supply chain issues are now easing. Both fuel and non-fuel import prices have fallen in recent months, and indicators of prices paid by manufacturers have moved down. While 12-month core inflation remains elevated at 4.6%, it has fallen nearly 3 percentage points from the all-time high. It is far too early to declare goods inflation vanquished, but if current trends continue, good prices should begin to go down and maybe reach the 2% level sooner than we think. Housing services inflation measures, on the other hand, now stands at 7.1% in the past 12 months. Housing includes both rental and ownership costs, and it's still very bad. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. You can see it on this report here. We've seen a gigantic increase throughout the pandemic, but now it's slowly starting to go down. We're still in a positive trend in terms of inflation. Housing is becoming more expensive from a rental perspective. And here I'm gonna add my little opinion. I don't think we're gonna see gigantic drops in rent because there are not enough places for rent. However, we will see a stabilization. As figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. Basically, landlords are seeing rents going up everywhere, so whenever they can renew a rent, a lease to somebody else, they're increasing prices. This is a trend that probably will go on through the next year. Now it goes on to talking about core services other than housing, which includes pretty much everything else: healthcare, haircuts, hospitality, so Airbnbs and stuff. Because wages make up most of this, as most of these services are related to the people that service. The labor market holds the key to understanding inflation in this category, and salaries have been going up. There's a huge shortage of workers. Demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be the consistent 2% that the Fed wants. So because of that, we still do not have clear data in this section here when it comes to inflation. Now, in terms of labor market, we have a shortage of 3.5 million people in terms of people we need to fill all these jobs. And reason is, on one side, we did not produce enough people in the past, let's say, generation to get into the workforce. On the other, we have a lot of people that came out of the labor force because of COVID sickness. And another major trend is people going into retirement. Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees. The reason is, on one hand, people simply were in a position to retire, people made more money and retired, and the main one is COVID boomed many of the, let's say, retirement accounts, so people were able to retire. If people sold everything, they made a lot of money. If they're still into their 401ks, they lost 20% of the 401ks in the past year. So I don't know, will we see older people get back because they lost money in their 401ks? We don't know about that. Wage growth too shows only tentative signs of returning to balance. Some measures of wage growth have ticked down recently, as we can see in this figure, but the declines are very modest so far relative to earlier increases and still leave wage growth well above the consistent 2% level. Growth in economic activity has slowed to well below its longer run trend, and this needs to be sustained. Bottlenecks in goods production are easing, and goods price inflation appear to easing as well, and this must continue. The fact is, yes, the Federal Reserve has been doing a really good job at shrinking demand, and we're now starting to see some shrinking demand. The thing is, now we need to sustain the shrinking demand, even shrink it more for supply to catch up and for companies to be kind of forced in dropping prices to incentivize consumption. Because you can incentivize consumptions in two ways. Either you drop prices, or you have people make more money. Actually, three ways. The last one is, or you give cheap credit to people with low interest rates, which right now is not the case because the Fed has been doing a good job at increasing rates. Returning to monetary policy, and this is the most important part of today, strongly committed to restoring price stability. This is the Fed's goal. Ongoing rate increases will be appropriate in order to attain policy stance that is sufficient restrictive to move inflation down to 2%. The full effects of our rapid tightening so far are yet to be felt. This is something that we talked about already in the last update. The Federal Reserve is starting to take into consideration the lagging effect of monetary policy. This means that they understand that whenever they increase interest rates, that effect will have an immediate effect, a smaller one, and then a larger, longer-term effect. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. This is very important. It makes sense to moderate the pace of our rate increases. The question is when. In the past month, we saw articles saying that the Fed might be pivoting or slowing down more sooner than what we think. They officially mentioned that they might slow down. The question is when. We have a little hint. The time of moderating the pace of rate increases may come soon, as soon as the December meeting. It may come as soon as the December meeting, namely in 3 weeks. We might see the Fed slowing down in 3 weeks. This is much sooner than what many people thought. This is what the market also expected. The market is expecting a 0.5% rate hike in December, which is lower than the 75 basis points increases we saw in the past couple of meetings. Given our progress in tightening policy, the timid as far as insignificant, the question of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at the restricted level. So the main question here is not how much we're going to increase next month or the month after. The main question that the Fed is asking itself is what is a good sustainable level of interest rates and how long should we keep the level to get to the 2% inflation and to a 2% inflation trend that stays there for a while. That is the main question. And in my opinion, that, let's say, stabilization of the Federal Reserve is what I consider the pivot of the Fed. If the Fed stops raising rates, is comfortable with the situation, the spread, meaning the difference between the federal funds rate and mortgages, will start dropping, meaning the mortgages, even if interest rates are not moving down anymore, the Fed interest rates, mortgages will start dropping because banks are feeling a little bit safer in giving out loans and people will come back on the market. So I believe that could be considered already the pivot without the Fed even needing to go down with interest rates. History cautions strongly against prematurely loosening policy. We will stay the course until the job is done. Again, this last statement is typical Powell, giving out some positive information and taking it back immediately, saying, guys, we still have some way to go, chill out, don't get too much euphoria. It is against the interest of Powell to have an euphoric market, because if you have euphoria, everything goes back up, people have money again, there's some spending, and we don't want that according to Mr. Powell. Guys, that's all for now. I will not interpret more than I already did now. I will leave interpretation to you. Hope this video gives you some good insights. To me, honestly, it looks pretty positive as an outlook. Thank you for watching and ciao.